So let's stay right there. The macro markets and your money, less on crypto, of course, because many think that the Peter Brady of the markets may finally emerge from Greg's shadow. Okay, that is the sectors and stocks that have been kind of ignored. Maybe we'll call it the pork chops and applesauce trade. You got to be old to get that. Energy, financials, industrials, they're suddenly red hot. And all in all, lower multiple so-called value stocks, of course, values in the eye of the stockholder, are up 10% year to date, while technology has largely struggled. Joining us now, Eli Salzmann, portfolio manager of the Neuberger Berman Large Cap Value Fund, rated 5 stars by Morningstar, crushing it this year, up 20%, outperforming the S&P 500 by nearly 15%. Eli, welcome. Thanks for joining us. Congrats to you and your clients on your performance so far this year. I mean, what have been the stocks that have really done it for you? I know it's just a short time period, and what made you see value in them when apparently others did not?
Sure. I guess in regards to your question, the first thing is energy. Energy has been very powerful for us this year. We aggressively bought energy last year when it was down and out of favor, sticking to our discipline, sticking to our process and philosophy, and behaving like a value manager should. And energy has clearly been a big part of that performance year to date.
I mean, I think that took some guts, to be honest with you, Eli, because all we talk about is fossils are doomed, new administration. It's all about renewables. It's been all about ESG, environmental, social governance, investing. You factor all that in. Oil and gas stocks have no future. They're going to wind down. Suddenly, 2021 has become the year of oil and gas. Many of these stocks have nearly doubled, albeit a lot of short covering and awful low. But what made you see something there?
Sure. Listen, for most of the last 9 years that we've been running this large cap value fund, we have been underweight energy for most of that time. One of the things that got us very attracted to energy over the last year was the amount of capital and capacity that's come out of the sector. If you look carefully at the sector over the last 6 years, there's been massive amounts of capital and, in turn, massive amounts of capacity that's come out. If you look at where the oil rigs were as of about 5 or 6 months ago, they dropped down to about 176. Normalized, if you look back over the last 10 years, it's about 800 to 1,000 rigs. So when you have that kind of capacity takeout and you can see the demand on the other side, prices are going up. So we got very, very aggressive on oil when oil went down to 18 and 20. And even for the brief period of time, it went to minus 37. And the 3-day period, it went to minus.
I don't know, for the holdings that you like, Devon, in the energy space, obviously they've been through a lot and a deal and kind of come out the other side. But it's not just oil and gas. It's also sort of they're going to not like this, the more old school financials, Comerica and Truist, which is kind of the old SunTrust.
Yeah, the answer is it is definitely time to own the banks also. We're entering an arena right now where, the financials are actually going to get paid. You got a steepening yield curve. You got non-performing assets, which are misunderstood and nowhere near going to materialize like people fear. And you've got a lot of capacity that's come out of the business, a la shadow banking and non-core financials. This makes it it's a much better landscape, however you want to slice it, for the banks and specifically for TFC and CMA.
Shepard Smith here. Thanks for watching CNBC on YouTube.